Hey guys, this is Justin. On April 30th, we interviewed 24 guests in a 12-hour live stream to raise money for Susan G. Komen in conjunction with our friends at Spot Gamma. Our guests were some of the smartest market experts we know, covering topics ranging from value investing to factor investing to macro and options. We are releasing each of the interviews in pairs of 2 over the week following the live stream to bring our guests' insights to our audience in shorter videos and to continue to raise money for a great cause. If you are able to, we encourage you to donate using the link provided alongside each video. As always, thank you for listening. Please enjoy our conversations with Meb Faber and Rafael Resendes. Meb, how are you?
What's up, y'all?
What's
How
up?
goes it?
All right. Good. Thanks for jumping on with us. We appreciate it. Probably don't need to give you an intro, but I'm going to anyway. Meb Faber, everyone, founder of Cambria Investments. Cambria has, I think I counted 14 ETFs today, with almost $2.5 billion in assets under management. We're going to talk to Meb about endowment investing and get some of his thoughts on what individual investors might be able to do to replicate some of these strategies and a bunch of other stuff. But before we get into that, just a quick reminder that today's event is to support the Susan G. Komen Foundation. There were over 7.5 million breast cancer survivors in the world in 2022. So obviously this disease affects millions and millions of men and women. And today's event is to just try to lend some support to this great foundation and cause. So if you can, there's a donate link at the bottom of the video on YouTube. Please consider donating if you have the means to. So Meb, let's talk. And, a lot of this kind of comes out of your the Ivy portfolio, which is a book that you wrote, but you're pretty vocal about sort of pensions and endowments and trying to help investors understand the ways they invest and the ways that an individual might be able to replicate some of those strategies. So, but let's start with an overview of how these pensions and endowments actually do invest their money.
Sure. So great to be here, y'all. If you look back at the long history of the big money in some of these endowments, not just talking about the past 10, 20 years, but really like past 50 years. Some of these early pioneers like Harvard in the early days and more in the recent few decades, Yale, helmed by the late, great Swenson, they definitely took a different path than most traditional institutions. You have this benchmark historically of the 60-40 portfolio in the US and kind of how that's evolved. And the decision was just almost always how much stocks and how much bonds. And that was the seesaw lever. And that was it. And a lot of these kind of real money institutions said, let's be a little more open-minded about what we can invest in, which is essentially everything. And once you expand sort of that worldview, then anything is on the menu. And the endowments, I think, have a spectacular track record. When we wrote the book, we said, look, there's some things we think they do that's really thoughtful and some things that they do that's probably not the best idea. And then, we said, how can like an individual investor really replicate the best of what they're doing with sort of minimal effort, as well as avoid some of the struggles that they have when most of us are not at 40 billion or something. So the things that an investor can do at 100,000 may be a little easier than what they can do at real scale and size. So the main things that they did and continue to do is have a long-term perspective, hopefully. And they understand that their greatest enemy is inflation. So making sure they maintain their purchasing power. And so the biggest kind of umbrella is that they say, we want to make sure we own assets that have equity-like returns over time. On average, the portfolio, we want to outperform inflation over very long periods. And we can dive into what that means. But that's sort of really the backdrop, is these really great performers who have done a great job at compounding for many decades, long-term horizon, and have the full secret menu from in and out of any possible investment in the entire world.
So their goal is, they're looking at a multi-decade type of, or maybe even longer type of time horizon and trying, the reason that they would include other asset classes is just for like diversification and trying not to get like blown out of the water. Is that what you would say?
Yeah. So if you look at the broad menu choices, the entrees, they're always usually pretty heavy in something global equities. So not just US, but around the world. Now, if you look specifically at something like Yale's, you say, well, Meb, what are you talking about? It says they only have 5% in US stocks or whatever it is. So we say equity like in things
Mhm.
that look like equities. So the main favorite of the past 10, 15 years, probably the savior for many, I think that they hope is private equity, which a lot of the endowments, we tend to disagree a little bit here, where they think there's going to be this magical 4 or 5% outperformance from private equity forever, despite the fact they're all putting money towards it. So equity is obviously the big one. Second, and the things that are essentially equity, private equity is equity, just happens to be private. The second is real assets, so in the early days, if you go back and look at some of the books written about Harvard a long time ago in the 20th century, real estate was certainly one that's obvious, both public and private. Then you have things that are sort of inflation protected sort of securities, so tips or commodity and commodity like equity type of offerings. Fixed income still plays a role to varying degrees in various portfolios. And then you have this big, giant slop bucket of other, which many different endowments describe in different ways. Some call it absolute return, some call it hedge fund type of strategies, but it's just that whole, um, side of the menu that's kind of like today's specials. Here's what our offerings that are somewhat different. It could be aircraft leasing, it could be all cat bonds, it could be all sorts of things that are meant to zig and zag. And so you reference, is it something that's meant to be an outperformer, or is it meant to be a diversifier, or both? It really depends. When you start talking about hedge funds, we always say the analogy is like, it's like talking about the average dog. A poodle looks nothing like a beagle. It looks nothing like a Great Dane or a Mastiff, right? And so just saying hedge funds or absolute return means a million different things. So the main things they got right: true diversification, long-term period, equity-like orientation. We think those are all really great choices. And then there's some things that we think don't do so great. But the good news is most individual investors could replicate that today. It's the best time ever to be an investor with a portfolio of ETFs that's, let's call it, I don't know, 5 basis points. So 0.05%, which is pretty incredible. That's also the challenge too. With 10,000 plus funds out there, it's easy to get seduced by a lot of choices, but it's a pretty awesome time, and you can do it pretty easy.
How does this work? So, they're obviously doing a lot of different things. They've got pretty big staffs. They're, hiring managers that have high fees in a lot of cases. Like, is there any aggregate data that tells us, like, is this adding value relative to what you talked about before, which is a lower, cost ETF portfolio?
Sure. So, as you mentioned, we've also been a bit critical of a lot of the big institutions. The favorite punching bag for me historically has been CalPERS, which is located in my home state. And, CalPERS is what, let's call it a $500 billion pension, as big as you get, as many resources as you could possibly want, the best in the world if you wanted to, managers at your disposal. Assets certainly give you a ticket to opening any door. And then, we talked about how has CalPERS done historically, how have the endowments done. The average endowment, does a good job, right? But you can replicate the average endowment fairly simply with a portfolio of ETFs. You have the Yales of the world and to a lesser extent, the Harvards of the world that have outperformed substantially over time. The question, of course, is, will that last going forward with increased competition and increased, pressure on all sorts of things in our world, TBD. But so we wrote a piece called "Should CalPERS be managed by a robot?" We did the same with the world's largest hedge fund, Bridgewater. Their all-weather and pure alpha portfolios. We said, you can get pretty close with just a portfolio of ETFs. So the replication of the beta of what they're doing, we think, is totally obtainable. So then it becomes a question of why do people spend so much time and effort on this decision, this asset allocation choice? And we had a recent podcast with the Nevada pension fund guy, Steve Edmondson, who I love dearly. And his story is the exact opposite. You know, they're the true foil to CalPERS, has hundreds of employees, hundreds of millions in fees every year. Like their position sheet is like 200 pages or something. He's like, you know what, we're just going to index the vast majority of this for as low cost as possible. And sure enough, they beat CalPERS and the average endowment over time. And usually it's by about the difference in fees, right? The ones that pay more, not surprisingly, it's a higher bar. And they only
Isn't
have
it just
one
him and
employee.
like one other guy or something?
Yeah, they now have two. Sorry. So they now have two employees, but
It's
for
crazy.
a while it was only one. So the good news is like you can be totally average, which is a compliment in our world. You know, average is not so bad in the investing world. And you can mimic the best of the endowment portfolios. But let's be clear, there's a giant elephant in the room, and the elephant's named SPY. And, you know, we have this very unique period in history. It's not totally unique, but the S&P has just steamrolled everything else in its path over the past 15 years, has done 15% a year since the bottom in 2009. Now, that's awesome, particularly for American investors that put most of their money in American stocks. God bless you. But also, you know, it's only happened a few times in history. It's happened, and they all have names, you know, the Roaring 20s, Nifty 50s, internet bubble, and whatever we're calling COVID meme stock mania. So diversification has not been rewarded for the past 15 years, which is a lifetime for most of us. Like it's careers for many people, 15 years. And so we actually have a piece coming out called The Bear Market and Diversification, where you look at any investing strategy, not just endowment style, but it could be risk parity, global market portfolio, 60-40. And so for the advisors listening to this is probably going to generate a little PTSD. So I apologize, but you know, every client conversation you've had in the past 15 years has been, why do we own foreign stocks? You know, remind me, like, what are these REITs doing in here? Could you explain commodities? Like, you gotta be kidding me. Emerging markets, China's down like 60%. Why do we own that? Everyone knew bonds at 1% was stupid. Why didn't you? So you've had to apologize every quarter for 15 years, and that's get old. These portfolios, most of them have had the longest streak of underperformance in terms of years in a row, as well as magnitude. I think the global market portfolio underperformed the S&P in something like 11 of 13 years, right? Not one or two, 11 of 13. Now that ended really in 2022. Well, TBD. We'll see what happens this year. But so this endowment style portfolio has done fine because of the equity orientation, but still S&P has creamed that as well for most of the styles and strategies. But over time, diversification, it certainly has been a much better choice.
Didn't you put in an application to CalPERS, didn't you, a couple times? Just to see, I don't know if you got a good response from them, but didn't you I think they had like a CIO or something at some point, you put your name in?
Yeah. You know, I've been very public about this, which I'm sure has not helped my chances, but I said for the last three, my criticism about the CalPERS approach, and here's the struggle, by the way. Most listeners, the only person you have to answer to for your asset allocation decisions is the person looking at you in the mirror, maybe your spouse, and that's about it. Like your children will be really unimpressed if, you know, you do poorly and bankrupt them, but really it's like a small universe. The incredibly challenging problem of something like a Harvard is you not only have the investment committee, then the investment professionals, you also have current students, you have alumni, you have future students, you also have university employees. So there's like 10 different conflicting interests that are going on in this management of these portfolios. And so you've seen it with the challenges with Harvard over the past 10, 15 years where it's funny because this article is old at this point, but we wrote an article where when Harvard was outperforming and doing great, you know, people were complaining about that the in-house managers got paid too much. When Harvard was doing poorly, there's articles in the Crimson about, hey, this is unacceptable. We shouldn't be underperforming these benchmarks and Yale and everyone else. And it's like this hilarious back and forth. But it's a near unsolvable problem. Now, Yale has been able to navigate this partially because they've been like the Michael Jordan of endowment management. But now that Swinson has passed, like, do they have an infinite leash? Like, we'll see. CalPERS has the same problem though. Like, it's infinitely complex for no reason. And you look at their position sheet. We always talk to investors, hey, you need to write down your investing plan, come up with the rules. Doesn't have to be hard. It could be on a note card. It could be 5 lines long. CalPERS is it's the most nonsensical investing document you've ever read. And so they've had in the past 10 years, like half a dozen CIOs. So I've applied to the last 3, but my joke that I put on Twitter, not a joke, I'm serious. I say, hey, look, tell you what, I'll be your CIO. I'll do it for free. So I'm going to save you hundreds of thousands of dollars right there, $1 million. I don't even know what they pay them. But I'm going to fire all your private funds over the course of the next 10, 15 years. I'm going to slowly move it to these ETF style portfolios. So I'm going to save you a bunch of money. We're going to automate it, make it systematic, can run it by a robot. We'll do a meeting once a year. We'll talk about the portfolio. We won't do anything. We'll rebalance. We'll have some beers and we'll call it a day. And I'll save you, I don't know, $500 million a year. They've declined the last 3 times, not surprisingly, to even interview me. But we may have something coming out in the not too distant future that will be a really fun horse race litmus test that I've alluded to many times on Twitter, where I say, hey, when we launch this, I want to take out the biggest billboard right outside of CalPERS headquarters, which I've been to present many moons ago, and say, hey, can you beat a publicly traded ETF? Let's find out.
Yeah, you wonder how places like Nevada even could do what they do, because you talk about all these layers of complexity. Like, how did they ever get through all that and get to the point where there's just 2 people like running it? I don't know if you asked him that.
My favorite part of the story, and this didn't make it into our podcast episode, and I want to preface this by, there was a Wall Street Journal article about Steve about a decade ago, and it was basically like the guy who runs the Nevada pension and beats CalPERS and does nothing all day. Like, it basically was the name of the article. And there's so many quotes about this that John Bogle and Buffett and others have made about kind of the waiting and just, not mucking around with your portfolios. Like, once you get things set up, you don't usually have to do much. And this didn't make it in the episode because I didn't want it to sound come across the wrong way. But Steve didn't seem to mind, and he was talking about it pretty openly in both the intro as well as the episode. But this to me is just the cherry on top, like just demonstration of it doesn't have to be endlessly complex for it to work. And we always say there's a million ways to invest that work just fine. So we have like a table, like comparison of Nevada and CalPERS, and so hundreds of pages, complexity, hundreds of staff and management, and then there's Nevada. It's like 2 people. You could put the investment plan on 1 page, and it's like CalPERS, shiny, beautiful offices occupying all this space in Sacramento. Steve, who by the way lives in a trailer. And as like I'm like trying to say this way about Steve, like, and not be derogatory. Look, my brother's got a trailer on our farm in Kansas. There's nothing wrong with trailers, listeners. Trailers can be beautiful and wonderful, but the fact that this dude manages $60 billion, and he's like, look, I live in Tahoe. I got the world playground in my backyard. I don't need some grand mansion out here. My kids are in college. Like, this mindset, it's a very like Boglehead sort of mindset. I think is so fantastic. And I just love this story so much. So, but it applies to all of us. Like, we talk a lot about investors and their portfolios full of clutter because they've accumulated all these positions over the years. The phrase in the industry is always mutual fund salad. Like, there's financial advisors that have been in business 10 years and they got 200 mutual funds. You look down your portfolio and you're like, God, I still own this. Like, if I cleaned house, if E-Trade went out of business tomorrow and my portfolio was zeroed, or I got divorced, or I had to transfer all this, whatever, like, would I go buy all these funds? Like, no chance in hell would I go do this. So, I think the idea of taking a blank piece of paper, writing down what we would like our portfolio to look like is a very useful exercise, can be very cleansing. And then if it doesn't look like what you currently have, there's time to make some changes.
I'm just curious for one more before I hand it back to Justin. This idea of these portfolios that are very different than the S&P or very different than the 60/40, we always struggle getting investors to stick with them because of what we just went through, these long periods where they don't work. I'm wondering, do you have any tips around that? Is anything you've done work? Because I know you run a lot of stuff like this that is very different than the 60/40. Do you have any tips in terms of getting investors to stay through these periods where they're different than the market?
Yeah. And we're actually writing a piece on this. We've been busy
Write a
lately.
piece on
So
everything.
we have 3 articles coming out this quarter. So we mentioned the bear market and diversification. The other one was called, is an update to an old piece we wrote called "Nobody Gets Fired for buying Vanguard. Maybe they should be," which is, we love Vanguard listeners, but it's a fun piece from 6 years ago. We've updated a current. And the last one is called essentially what you're talking about, which is, we haven't come up with a title yet, but it's something like a guide to buying Cambria ETFs. So, but really it's a guide to buying anything. And here's the struggle is, like, we work with professional investors. We have 150,000 investors all the way around the world. And I always don't want to shame the professionals. Always love to look down at the individuals. And we always say, these crazy individuals, they're so dumb. They're trading Reddit stocks and doing dumb things and chasing these hot managers. But, the pros, I mean, look, CalPERS sold their entire tail risk position like the week before the pandemic hit. So, or the month before. So it's like, these institutions often are just as bad. They have fancier sounding names and sophistication. And so we've heard a lot of things over the years from investors where it's like the nails on the chalkboard. It's like you hear something or you're just like, oh, I know how this is going to end. This is going to end so poorly. And so I said, this piece is not meant as a public shaming, but it's meant as a guide. So, like, we talk to an advisor, say they buy 10 million in one of our funds, hopefully it's 100 million. And we say, hey, look, this isn't directed at you, but, like, take a look at this piece. Maybe it'll help you think through how to go about what you're going to do with this fund. Because here's what happens. Even if you're the most diligent investor, like, the phrase we've heard so much over the past 5 years has been, my investing decisions are evidence-based. I base them on process, not performance. So let's say you come to Cambria, you read one of our books or white papers about one of our funds or strategies. You called us, you did a due diligence meeting, you came out to Manhattan Beach. We went and had a coffee or margarita. You did all your due diligence. You read the prospectus, which no one does. You did all this. And then so you say, I'm going to buy it. And then I say, okay. And then what? Right? Most people say, I'm going to buy it. And then what's the plan then? Like, I'm going to see how it goes, right? We hear that all the time. Hey, Meb, I like your fund. Looks great. I'm going to buy it and we'll see how it goes. I mean, like, what the hell does that mean? What do you mean, see how it goes? I'm going to tell you what that means.
We've had people too that are like, put us in like a horse race. They're like, we're going to put you against this other manager for 1 year and whoever wins, we're going to go. So people do that kind of stuff all the time.
That reminds me, I need to write that down because that didn't make it into our piece, and I need to add it because we don't hear this as much, but we still hear it. Say, hey, Meb, we're going to buy SYLD in cows, and we're going to compare you to these two. And I go, okay, and we'll reevaluate in a year. And I go, just to be clear, in a year from now, you're going to add to the one that underperformed, right? And they say, no, what are you talking about? I say, well, 1 year, like, what could you possibly learn from 1 year? We recently had Ken French on the podcast, and he's like, he's got a great quote. He's like, 1, 3, 5, or even 10 years. Anyone who tries to draw any inferences from 1, 3, 5, or 10 years from a asset class or an active strategy is insane. Who bases their decisions on more than 10 years? Zero people. Zero. Like, I've never met any advisors like, you know what? So anyway, here's what the document does. It goes through 4 things. It says, all right, 1, nobody has an investing written plan. None. So we do polls and no one does. We say, write down your plan. Doesn't matter what it is. just very simple. Write down what you expect your plan to be. You're going to buy one of our funds or buy whatever, some ETF. Write down why. Doesn't have to be complicated. Just be like, here's why I'm buying this fund. Is it a Lego building block, in which case I'm going to sub out something in my portfolio in hopes that I think this is going to increase return or reduce volatility, right? Like, is it going to be a diversifier? So I'm going to write down why, or B, is it a totally new asset? So not a sub building block, but something totally new. I'm adding private farmland. I'm adding trend following, but why am I adding this? Okay. And then what are your expectations? Okay. I expect this to have the same returns as the S&P over time, but similar volatility. And I expect it to, however, diversify usually in the bad times, but maybe not always. And I expect that this fund could go 3 years in a row underperforming the S&P. I expect that it could go an entire decade, absolute underperformance, and still be a viable choice. Whatever it is, write it down. And then next is like, how long do you plan on holding this? Like, what is your measurement period going to be? And how do you think about rebalancing? And eventually, how do you think about selling it? And I guarantee you, no one's gone through this process, because if what they say and what they do is always opposite. I say, I'm process-based, not performance. And that's always true on the buy decision. People do make that. They do their homework on the buy. But on the sell decision is only one criteria. Did it outperform or underperform some arbitrary benchmark or your neighbor or what your client's complaining about, right? Because in many cases, it's like playing poker or blackjack, right? It's like, did you make the right decision ahead of time? The outcome in many cases is completely random or unclear, right? And so this document, I think, is a helpful. It's I think going to be, as with many of our views, non-consensus and some of the ideas about how to work through some of these challenges. This is a really long-winded deviation from your original question: is how do we get people to behave? I think the first is studying history and having some expectations about the markets as well as the strategies. So understand how crazy markets have been, understand how crazy strategies have been. And I'm not talking about for the last couple of years, the last 100 years. And even then, understanding 100 years isn't that long of history. And then putting it all together into a portfolio and trying to understand, how these pieces fit together and what the expectations are. And we have a long description. And so part of this is from Vanguard and others, where it's like, even if you pick a kick-ass active manager, guess what? They're going to underperform like half the time and probably underperform, numerous years in a row. But how many people expect that? All the surveys we do is say, hey, I'm giving someone 0 to 3 years, and then that's it.
Meb, these 30-minute conversations are kind of tough and they're tight, but
I thought we had an hour. Come on, guys. I was just warming up. You sent me like a 3-page question document.
Well, that's why you're coming back on excess returns soon for us, hopefully. But in 60 seconds or less, sort of the final closing question we're trying to ask everyone is, what is one interesting thing you're seeing right now that others should be paying more attention to?
We have an entire Twitter thread on things that we believe that no one else believes. And we're up to about 20 right now. One of those, which I need to add, thanks for the inspiration, this might be number 21, is it's totally insane to me. We just wrote a white paper called T-bills and chill most of the time. I don't know why anyone takes credit, duration, all these other risks in the fixed income market if you're not getting compensated for it. So if T-bills are giving you 5%, we're rounding, but corporate bonds or junk bonds or emerging market bonds or 30-year is yielding 5% or less, it seems crazy to me to invest and take on these risks. It's like buying a stock trading at 100 times revenue, which people seem to want to do. So we wrote a paper that kind of modeled out historically, does it make sense to buy all these fixed income riskier bonds when the spread versus T-bills is narrow or even negative like today, or super wide? And guess what? It's smart to buy it when it's super wide, and it's not that smart to buy it when it's super thin or negative. So the bad news is, or good news, depending on your perspective, right now is you want to be T-bills and chilling. We launched a fund to do this, but nowhere can we find a reasonable spread right now? So either the spread's got to blow out, or T-bill yields got to come down, or both.
Right. Great, Meb. Hey, thank you. We really appreciate it, man. Sorry this was a little rushed, but
Awesome.
always good to catch up. Thank you,
Love
Meb.
what you guys are doing. Look forward to catching up in the real world, and looking forward to tuning in the rest of the day.
Cool.
Thanks, Meb.
Thank you. Rafe,
Hey guys.
how are you?
Hey,
Sorry,
Rafe.
we ran 1 minute over with Meb, but welcome. Thanks for doing this with us.
Okay.
Yeah.
Good to see
So-
you guys again.
Yeah, great. Just quick introduction here. Rafael Resendes, co-founder of Applied Finance. Applied Finance is an asset manager running value strategies, specifically intrinsic value strategies that try to really uncover the true drivers of valuation and wealth creation. We're going to talk about that today with Rafe. But before we get into all that, just a quick reminder of what today's event is all about, which is supporting the Susan G. Komen Foundation. We pulled some facts here. So one of the amazing things with breast cancer in this country is from 1989 to 2021, they've seen a pickup of or decline of over 42% of breast cancer in terms of death rates in this country. So clearly making progress on that front, but we still got a long way to go. And so foundations and charities like Susan G. Komen are important in helping in that way. And anybody that can give, we certainly appreciate. We appreciate it. So with that, Rafe, what I thought we would do, out of the gate here, just to start, because it's a great story. It's a great story about perseverance and long-term thinking, but maybe.
We live our book of being long-term investors, that's for sure.
Yeah. So just quickly walk folks that might not know a lot about Applied Finance through your history and background.
Yeah, sure. We did not begin as investment managers. We began as strategic management consultants. We had a great practice that we built with Arthur Andersen to help companies understand how their actions would affect their stock price through a series of models Dan O'Berkey and I built in 1995 and 1996 that linked corporate performance to intrinsic value. And that's been the cornerstone of everything we've done since. We're really proud of the fact that over that time period, we've estimated over 20 million live point in time estimates of intrinsic value for firms globally. So it's a very deep live research database, live out of sample database that's really rare in the industry. So we started as management consultants. Our very first assignment was for General Motors, and it was written up by CFO Magazine. We were helping them try to set hurdle rates for their various factories around the world. And we used an approach that we sort of pioneered and were one of the early developers of, which is extracting market-derived discount rates from equity markets all around the world. We would basically create one consolidated firm, forecast out a series of cash flows for the firm in each market, then solve for an internal rate of return that would equate the market value of equity and debt to the future cash flows of the entire market. And that gave us the ability to compare investor expectations around the world for Brazil versus Germany versus Japan versus the US. So really innovative. CFO Magazine loved the idea. General Motors, when we made the pitch, we were competing against more traditional finance types such as Goldman Sachs, McKinsey, and so on. They really thought it was an innovative process. And that was the start of a wonderful relationship with Arthur Andersen. Never in our wildest dreams did we think we would outlive Arthur Andersen as a firm. And unfortunately, they went belly up due to a few, rogue actors auditing Enron and MCI and so on. And so they were 95% of our revenue base. So we had to reinvent ourselves, and we started selling the same insights that we gave to corporations. We started selling them to asset managers, particularly RIAs around the country. And by, I think, 2007, Thompson Financial said we were the 13th largest independent research firm in the country. And then boom, the great financial crisis hit. And that wiped out a big chunk of our revenue base again. So we sort of had to rebuild. And what we did this time is we thought, you know what, we just want to ultimately cut out the middle person and be responsible for harnessing our intellectual capital ourselves. So we worked towards getting in a position where we could concentrate our efforts full-time on asset management, which we did in 2017. And, our research has been really well received in the marketplace. In 2017, we had inched our way up to about 100 million of AUA and AUM. And I think at last count, we're bucking up close to 5 billion over the last 7 years. So it's been really rewarding, but it clearly you see why small firms can have a high risk premium attached to them.
Yeah, good story. Thank you for sharing. I think that's an important sort of backdrop here for understanding the firm and what you guys are all about. Let's discuss, I think you might have some slides, and we wanted to open up with this idea about safer market investing in stocks specifically. Some people might hear safer markets and feel like we're going to be talking bonds or gold, or no, we're talking safer markets in equity investing. And I thought you could kind of discuss what safer markets actually means to you and why it's important.
As I mentioned, we spent a lot of time cleaning up the accounting data to move from kind of as reported accounting information to put it into the context of an economic framework to evaluate company decisions. One of the things that I think is really unique about what we do, everything we do is live out of sample. We created these models in 95 and haven't really tweaked them since, haven't really changed them since. So, we do things such as we've been capitalizing R&D since then. We've been capitalizing leases. We have a very continuous set of data, and that's allowed us to really look and understand what types of companies are likely to make good investments and what types of companies are likely to make poor investments. So we segment that into two distinct buckets, if you will. We think of things in terms of a stewardship component. Are companies doing the right thing to run themselves in the interest of their owners? And then we think about it from a intrinsic value component. Are companies trading above or below their intrinsic value? So there's three aspects to stewardship that we really focus on. One is, are companies destroying wealth? Are they investing below their cost of capital? What we don't want to see, our base default assumption is companies should never have the right to invest your money. They have to earn that right. And they earn that right by continually making smart decisions leading to wealth creation. Specifically, we want to see firms that are investing and earning more than their cost of capital. That's piece one. Piece two is we like to avoid companies that are overly dependent on external financing. And the problem with companies that rely too much to achieve their plans on external financing is that ultimately, if they run into a liquidity problem, they may be stuck with a lot of fixed cost equipment or a lot of fixed cost projects that they can't flow to completion. And so we believe that's another factor or group of firms that consistently has shown a propensity to underperform the market. And lastly is, through our valuation lens, we like to avoid what we call value traps. And specifically, those are firms where when we do a discounted cash flow of the expected future economic profits and cash flow that they generate, that the present value of those cash flows exceed the book value of the company's assets. So present value of cash flow minus debt should be greater than the book value of the firm's assets. Otherwise, the entire business plan for this firm is essentially a wealth destroying business plan. So those are the components that make up a stewardship component. And then we want to eliminate overvalued stocks. So when we take both of these pieces out of the market, we believe we've really stacked the deck in favor of investors. And we can look at some of the quantitative properties of these metrics by factor, if you will. If we slide down to the next page, Jack, we just kind of lay this out factor by factor in terms of what we're looking at, in terms of the long-term returns to each of those from the stewardship perspective. So you can kind of see piece by piece what happens to these factors. So companies that are reliant extensively on external financing have tended to underperform the market by approximately 200 basis points a year. Wealth destroying companies, these are firms that are investing in projects or have ROIs below their cost of capital, yet rather than rationalizing their business and fixing the business so they're earning more than their cost of capital, they continue to grow. Those firms are basically earning close to 300 basis points below the overall market. So these are really important firms to think about. How do we have a very broad-based portfolio without having to pick, a handful of stocks that outperform, the view of a safer market perspective is let's get rid of stocks that we know are systematically doing the wrong thing on behalf of their owners and focus on the remaining stocks in the marketplace. The other thing about these companies, not just do they underperform, but, in the classic portfolio construction arena, we would think, okay, well, maybe these stocks underperform on average, but they have redeeming features that when the market really sells off, these types of stocks hold up well or provide some risk attributes that are favorable. If we look to the next page, in general, these stocks are really bad from a drawdown perspective. Regardless of the factor, these stocks almost uniformly, consistently outdraw down the market or have greater drawdowns in the market through time. So even though they're getting lower returns, there's really not a lot of redeeming facts from the perspective of, well, maybe during a really bad time, these are okay stocks to own because you're earning lower returns on average, but they make up for it by saving your bacon when the market sells off. So these are just in general really bad stocks to have in your portfolio. And so when you buy an index, you're getting all of these, and it's what we call the passive performance tax. You consistently are over-investing in companies with really poor stewardship properties. So if we take the market and we bifurcate it just on the basis of stewardship, good stewards and bad stewards, we see this next chart here, which is really kind of nice. It shows very consistently, just regardless of whether stocks are over or undervalued, just focusing on companies that are doing the right thing on behalf of their shareholders, that's the blue line, they tend to do a nice job outperforming the market. Not only do they outperform, but they do so with a lower beta, generally lower standard deviation. So they have a lot of nice attributes that lead to what we would consider to be a safer market than buying the black line, which is the market. And then overall, that red line, which is the stewardship fails, really do a poor job in terms of protecting your wealth and growing your wealth. They significantly underperform. They have higher drawdowns. They have more volatility. We believe you're just much better off if you want a broad portfolio. Just think about excluding them altogether in your portfolio construction process. So we can take this one step further and start to think about, great companies don't always make great investments because they may be overvalued. So that's the last step of the puzzle in creating a safer market, is putting some potential guardrails in place to avoid really overvalued stocks at points in time. And the interesting aspect of this, again, is when we started our company in 95, we really didn't want to deal with the aspect of multiples. We wanted to have an entire look at the intrinsic value of the firm. So whenever we think of valuation, we don't think of cheap or expensive. We focus on the concept of, is the fundamental worth of the company more or less than what the market's paying for? So on the next slide, what we see is we just basically took the Russell 1 through time and segmented into the 30% most undervalued stocks and the 30% most overvalued stocks from the perspective of intrinsic value. And there's a couple interesting points here. One, intrinsic value by itself, regardless of whether a company management is doing the right thing, does a very nice job segmenting the marketplace. Undervalued stocks significantly outperform overvalued stocks. And while the intrinsic value as a metric did well when traditional value did well, when cheapness or multiple stocks did well, when you incorporate all the aspects that lead to understanding intrinsic value, profitability, growth, risk, and competition, what we see is during this period of the last 10 years where value investing sort of stumbled, intrinsic value was able to continue identifying what we think were really interesting investment opportunities. I mean, in a number of our live portfolios that we were delivering as model delivery products, it's owned Alphabet, Apple, Meta, going back to the early 20 teens. So even though they traded at very high multiples, they were fundamentally undervalued relative to their intrinsic value properties. And so again, similar to stewardship, intrinsic value has really nice attributes with respect to drawdowns. The most overvalued stocks have horrifically bad drawdown patterns. So even though you have these overvalued stocks, you're not necessarily getting compensated ever for owning them. You know, some folks would say that's mispricing. We like to think of it as these are just risky stocks to own in your portfolio. You're accepting risk that you're never going to get compensated for. Never is a harsh word, but rarely are you properly compensated. And over the long run, it's really worked out to your disadvantage to own overvalued stocks. So the second piece of the passive performance tax in terms of our research framework is that passive investing systematically overinvests in overvalued stocks. And again, in the same way that Warren Buffett always says, in investing, you get to be a batter that goes up to the plate and you don't have to swing until you get the right pitch. As an investor, you don't have to take all stocks that are public to own what we think is a superior market index. You can take the stocks that are being managed and run in your favor and gives you a favorable risk return profile in terms of when you buy them. So when we put it all together, what we end up with is what we call an intrinsic value stewardship portfolio. The theory behind it is on the next slide, which is it's a broad cut from a valuation perspective. We're eliminating the 50% most overvalued stocks along with the stewardship fail stocks. And it's done a very nice job relative to the overall market, low tracking error, nice alpha, similar beta, similar standard deviation. From our perspective, it's just really solid blocking and tackling to get at the problem of how do we own a big, broad, diversified portfolio of hundreds of stocks, yet still get alpha. And so on any one year, this last chart here, the next chart rather, is what we like to look at in terms of, we call it a consistency chart. And it basically looks at over different time periods, how does this type of approach work? Well, in any one year, the batting average to this strategy, this process or this framework, this thought process to own and construct a portfolio is about 66%. But the longer we stay with it over different rolling time periods, the better and better the returns get. So in 1 year, it's 66. It goes up into the 80s by 3. It's in the 90, 95 by 5, and by 100, by 10 years, you've basically achieved 100% 10-year rolling outperformance relative to the base index with similar underlying volatility and risk characteristics and a very high information ratio. So we think this is a really unique approach that kind of takes all the strengths that we do as a firm. We're a very quantitative firm, but we spend a lot of time fundamentally analyzing data at company specific levels. We've maintained a very unique custom database of fundamental data for the S&P 500 since we launched a product dealing with the S&P 500 as a universe almost 20 years ago. So it's very unique, the combination that we have of fundamental and quantitative, the way we've really done a nice job combining the two to clean up data, move data from accounting to economics, and then lastly, avoid a lot of the problems that most valuation suffers at the hands of qualitative opinions from analysts. And one of the things that I think is so interesting about valuation is you have a lot of valuation experts out there, but if you ask them to demonstrate to you or prove to you they actually know what they're doing, they can't, because they don't have any data to consistently show. If they say a stock is overvalued, the market moves up to that price. If they say a stock is undervalued, the market drops to that price. We had a group of academics study our intrinsic value back in the 2000s from Michigan State University. And what they found was, after controlling for umpteen other factors, prices tended to converge to the applied finance level of intrinsic value at the rate of about 15 to 25% a year, which we thought was really satisfying in the sense of getting a third party to take a look at the efficacy of our intrinsic value and sort of risk adjusted and factor adjusted and reach that conclusion. That was a really gratifying academic result for us over time.
So when we looked, like people like me looked at value in the past decade and looked at it as cheap relative to growth because of spreads, I'm assuming your system did not agree with that, right? Your system was looking at intrinsic value and was saying, all right, maybe there's something going on with these growth companies that makes them warrant that higher valuation. And so if not as cheap as someone like me might think.
You're absolutely right. I think it's funny, when we talk about one of our strategies, we have a slide where back in 2011, we were considering two stocks. We were considering Alphabet and Tupperware at that time. And when we looked at those stocks, Alphabet was trading at a 50% multiple premium to the market, and Tupperware was trading at a 35% discount. And then you fast forward from 2011 to 2019, Alphabet's premium grew and Tupperware's premium shrank. And yet, from an intrinsic value perspective, in 2011, Alphabet was undervalued, Tupperware was overvalued. In 2019, Alphabet continued to be undervalued and Tupperware continued to be overvalued. And the key difference there was Alphabet was an incredible wealth creation machine. They were earning 7, 8, 9, 10% spreads above their cost of capital, reinvesting in their business at 10, 15, 20% a year. That compounded wealth continued to increase their intrinsic value over that entire time period over the last 10 years. And I think the question you mentioned is really fascinating in terms of, what we think are some things to look out for and be aware of in today's marketplace that maybe other people aren't thinking about the same way we do. And this whole notion of the value gap, I think this became something that really came into prominence right before COVID and has sort of persisted since then. A lot of folks have been making a lot of noise about how attractive value stocks were relative to growth. And so this is a simple chart that we created to highlight kind of what's happening to growth and value portfolios from the perspective of economic profitability, as opposed to just simple accounting profitability. And what I think is really fascinating here is when you go back to 2000, in the 2000s, when we had the second most historic value gap that people talk about. Today, they say the value gap was higher than it was in 2000. Well, what's fascinating about 2000 is that if you look at the chart on the left, the green line depicts the economic margin, which is kind of the economic ROI of the firm minus its cost of capital. The green line depicts that average economic margin to the portfolio of value stocks. The red line depicts it to the portfolio of growth stocks, and the gray line is the market. So in 2000, what's really interesting is you were buying value stocks with relatively similar profitability to growth stocks. Growth stocks had a little bit higher profitability on average, but for the most part, value stocks were really profitable on a relative basis. And yet you had this massive divergence in their multiple. And when you go back to what is intrinsic value is the present value of future economic profit and growth in those economic profits discounted to today. Value and growth were starting at very similar periods, yet their multiples were wildly different. Today, we're at a point where growth stock profitability is slamming value stock profitability. So yes, they trade at different multiples, but unless you take it all the way to understanding intrinsic value, what we see is that value stocks should trade at a significantly higher multiple because they're so much more profitable. And I think that's whenever you compare multiples through time and you're reaching a conclusion about today, your underlying assumption is that everything is the same. And more often than not, that's not the case.
That is a very interesting chart and very eye-opening when you look at those types of profitability spreads. Rafe, I know most of your business is done through financial advisors, but obviously individual investors can buy your funds or purchase your ETF. Actually, I think your ETF just hit its 3-year track record, right?
That's right. That's right. It did. Great. It's performed. It basically is the first implementation of this safer market set of principles, and it's performed just like it should. I think it's outperformed It's indexed in the Morningstar universe by approximately 150 basis points a year after fees with lower volatility, which is exactly in line with the research.
Mm-hmm. If people want to learn more about applied finance, where can they go?
Appliedfinance.com.
And you are on Twitter. Try to find Rafe on Twitter handle.
It's hard to do. If you like to follow, if you like to follow esoteric finance references and a lot of cooking pictures and boost pictures, Resendes at Twitter, at Resendes is my handle.
Yeah, great. Thank you for coming to the table so prepared. You made this discussion super easy for Jack and I. Sorry about the presentation sort of thing, but
no, that's my fault. And thank you guys. What a great cause. Thank you for having me be a part of this. It's really an honor and it's fantastic.
Thank you, Rafe. This is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJCarbonell. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.
Justin Carbonell and Jack Forehand are principals at Validia Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital.